Hello, and welcome to Mayor Brown's Navigating the Storm, Initial Structuring, Exit Strategies, and Tax Controversy Considerations in Asia, the European Union, and Brazil webinar. My name is Andy Beck, and I'm a partner in Mayor Brown's San Francisco office and a member of the Tax Transactions Practice Group. Joining me today as co-presenters from our tax practice are Pierre de Ritter, a partner in our Singapore office, Benjamin Homo, a partner in our Paris office, Celso Grisi, a partner in the Sao Paulo office, and Jason Osborne, tax controversy partner from our Washington, D.C. office. A truly global panel indeed. I want to thank my co-presenters for being here today. Before we begin, we'd like to mention a few housekeeping announcements. Please note when accessing Mayor Brown's webinar via our On24 platform, we suggest avoiding use of desktop virtualization software, such as Citrix, decreased disruption, or quality loss. Secondly, as listed under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there is no dial-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. If you have any questions that are unanswered during the presentation, I invite you to submit them using the Q&A feature on the right side of your screen. Regarding CLE credit, we'll be providing an alphanumeric code during the presentation. In order to receive CLE credit, participants must record this code on the virtual sign-in sheet that was emailed to you with the login instructions for today's program. These forms are also available to download on the right-hand side of your screen under Resource List if you need them. In addition, please visit our COVID-19 web portal on mayorbrown.com, which is a one-stop resource center that aggregates the latest Mayor Brown legal updates and insights on COVID-19 and includes links to other useful resources. With that said, let's get started. A couple clarification points to make sure we're all on the same page in terms of the specific issues we'll be discussing today. We're looking at cross-border acquisitions of local source country target entity, target that is a resident of country X, as depicted in the diagram on this slide, by an overseas multinational company, MNC in country Y, or a private equity fund whose investors, limited partners are from countries other than country X. We're focusing our discussion of country X tax scrutiny to a share sale of targets by such MNCs and private equity funds. Why? Because often such exit transactions try to avail of the tax treaty-based exemption from country X capital gains tax, and the tax amount at stake can be significant. The diagram on the right is a classic illustration of this. HC, or holding company, has been set up in country Y that has a favorable treaty with country X, which exempts HC's gain from selling target shares from country X tax. So why do we believe this area of exit-related tax scrutiny is the perfect storm? One of the key factors behind the accelerated and sophistication of the tax authorities around the world in recent years has been the OECD's ongoing work on BEPS, or base erosion and profit shifting. This globally coordinated tax initiative has led to many countries actively engaging to address perceived tax treaty abuse, which has in turn contributed to a better awareness of often complex cross-border tax issues. The next one is directly related to the pandemic. The many economic stimulus measures that the governments have had to enact in response to the pandemic had led to many governments currently being in a deficit. To replenish its coffers, many governments will be looking for sources of additional tax collection in the near future. And it will be politically difficult to target locally owned businesses for additional tax revenue. The focus for tax collection will most likely be on large inbound multinational corporations and other foreign investors such as private equity and real estate funds. As tax audits and tax assessments increase on foreign investments and their underlying cross-border transactions, local tax controversies will correspondingly increase. Each country's tax appeals and judicial review processes will differ, in some cases quite significantly from the U.S. and one another. In some countries, there may not be a viable judicial review due to operating procedures, customs, or even due to the impossibility of getting a tax assessment overturned. But what is important is that the post-tax assessment venues for the target country be assessed up front, as this could be a factor in determining the initial acquisition structure, evaluating if applicable, the necessary tax provisions. So what are the actions needed to navigate this storm? As you'll note from the discussions today, the key is to anticipate everything and plan early. And if I may add, to listen to this and other Mayor Brown webinars. The tax considerations in the initial structuring and the subsequent exit will differ country by country. With that in mind, we will in this webinar discuss the relevant and practical considerations in the following stages of an investment. First, the initial target acquisition structuring. The initial structuring is critical in ensuring that the tax objectives from the target acquisition are achieved, whether it is obtaining a 5% dividend withholding tax benefit as compared to the no treaty domestic rate of 20% under an applicable tax treaty, or obtaining treaty-based capital gains tax exemption. For private equity funds, a decision will need to be made whether to rely on the traditionally used Cayman fund vehicle and treaty-favored holding company underneath the Cayman fund to acquire the target in country X. Or, in light of concerns over the Cayman structure, utilize a new onshore platform in Luxembourg or Singapore they have been evaluating. Here, factors such as where substance exists or can be added, the main tax objectives from the investment, likely exit scenarios, and regional deal team activities will all be relevant. It is also important to monitor and maintain the structure post-initial structuring and before the subsequent exit. In practice, we often find that the work that went into the initial structuring and the tax-related protocols to be followed during the holding period are ignored and sometimes actually contradicted by the actual activities during the holding period. Also, it is important to monitor local country tax developments, which is a must, as countries increasingly enact anti-abuse tax rules and treaties are continuing to be updated. We'll also touch on, as relevant, the exit and post-exit tax audit and controversy, focusing on the practical best practices. In the last segment of today's webinar, Jason will discuss the U.S. mutual agreement procedure and U.S. foreign tax credit relief considerations that are relevant for U.S. MNCs and investors that face tax controversy in a foreign country. With that, let me turn it over to Benjamin to start us off with the European Union.
Thanks, Andy. As a preliminary remark before we dive into the topic, it may be worth mentioning that while this section of the slides is entitled The European Union, to a large extent it remains necessary today to apprehend tax issues at a country level rather than at the union level. Indeed, taxation is one of the areas for which decisions require a unanimous approval from the 27 EU member states, and progress in this field has been impeded by the diversity of situations among the members, with the notable exception of VAT. As a result, from a tax perspective, this union largely remains, in fact, a juxtaposition of separate tax systems, subject to certain specific topics for which the member states have found common grounds. Beyond VAT, these include most notably the tax treatment of cross-border flows of dividends, interest, and royalties between related parties. Why is this important? Because it means that when considering exit taxation issues, the analysis has to be made on a country-by-country basis to identify which flows can be subject to taxation and which tools are available to taxpayers to manage this taxation. The chart on this slide shows a small selection of Western European countries, including the UK, which are notable jurisdictions for foreign investment, particularly by private equity funds, whether as target countries or as intermediary locations. It shows whether, based on the domestic rules applicable in these jurisdictions, local taxes may apply on various kinds of flows, thus imposing on foreign investors the obligation to seek the protection of tax treaties or EU directives. This chart provides a good illustration of the diversity of situations I just referred to, and it includes some easy-to-catch insights on the type of issues that investors may face. For instance, you may note that all the countries in this chart levy withholding taxes on dividends except for the UK. This means that if dividends have to be repatriated out of the EU, having the UK as the top entity in the European structure chart could be interesting. Any profits distributed to the top entity by its EU subsidiaries could be upstreamed to the foreign parent without needing to worry about meeting the stricter and stricter restrictions imposed by countries to grant the protection of tax treaties. Of course, this may be jeopardized if the UK company itself suffers withholding taxes on the repatriation of profits from its EU investments, so a UK parent company does not solve everything. Another takeaway from this chart is the fact that withholding taxes on interest are less universal than those applicable to dividends. Because it does not tax outbound interest, Luxembourg has been a favored location for investment platforms, notably because it has always interpreted quite broadly the notion of financial expenses that can be paid free of withholdings. These include, for instance, any sums paid by a debtor for the repurchase of debt instruments, even if this repurchase is made at a price that takes into account the value of the underlying shares into which the instrument can be converted. That is, even if the amount upstreamed exceed by far the nominal value of the debt and accrued interest. Finally, it is worth pointing out that 3 countries, France, Italy, and Spain, tax capital gains derived by non-residents from the sale of substantial shareholdings, that is, shareholdings of 25% or more, in local companies. This capital gain taxation is potentially very costly, often far more than withholdings on dividend and interest, and can generally only be eliminated if treaty protection is available, or in some cases if the seller is an EU company, but in that situation domestic anti-abuse rules still require strong justifications from taxpayers. So it is important to bear in mind that there is no one-size-fits-all answer to exit tax issues in Europe. The concerns will not be the same for a foreign private equity house or a multinational company investing in the UK or Spain, and the tools to be relied on to limit tax leakages will not be the same. Where taxpayers will usually turn to tax treaties to shield themselves against capital gain taxation, they will often turn to EU directives when it comes to dividends and interest flows. Local tax authorities approach these issues more and more aggressively, but foreign private equity funds make a particularly attractive target because their teams are comparatively smaller as a general rule than those of multinational companies, making on-the-ground presence more difficult to achieve. Also, funds suffer from a trust deficit on the part of tax authorities, who tend to approach their investment structures with a certain degree of suspicion, not to say preconceptions. Because of this, it is important for private equity funds who invest in the EU to take a holistic approach when seeking to strengthen their European presence and their eligibility to EU directives and tax treaties. This implies that all the components of the funds be worked on to limit as much as possible the openings for the tax authorities. These components, broadly speaking, are the fund platform itself, that is, the vehicle or vehicles in which the fund's limited partners are committing themselves, the investment platform, that is, the intermediary entities and vehicles used between the funds themselves and the local acquisition vehicles established for each investment, and the management and advisory platform, that is, the various companies hosting the fund's team members, that's the manager, the GP, the AFM, etc. An optimal tax position requires that each of these pieces be taken into consideration and organized with a view to strengthening the arguments that will ultimately decide whether directive or treaty protection is or is not available. In the next couple of slides, I will focus on the fund and investment platforms, but these two discussions will, of course, de facto drive the situation of the management and advisory platform as well. In a private equity house that has decided to locate all of its funds, vehicle, and investment entities in Luxembourg, maintaining exclusively UK teams will become harder and harder as time goes by. As we mentioned during part 1 of this 2-part webinar, we are seeing a trend of onshoring funds in Europe. This trend may be accelerated by the warning that the EU gave by placing the Cayman Islands on its blacklist, though it is unlikely to stay there for too long, but its roots may be found more broadly in the tightening of anti-abuse rules that we also discussed in part 1. The need to implement genuine arrangements to benefit from withholding tax exemptions offered by directives, as well as the need to establish a strong rationale for both the existence of any EU investment vehicles used and the choice of the jurisdiction of these vehicles, drive private equity houses to locate in Europe more than just their intermediary holding companies. They are helped in this respect by the variety of tools that EU jurisdictions, and first and foremost Luxembourg, have developed over recent years to take advantage of this trend. Each foreign fund can take its pick among the various forms of vehicles, regulatory regimes, and tax regimes that Luxembourg offers to recreate locally arrangements that mirror those they used to operate in non-EU jurisdiction. This is not to say that Luxembourg is a magical solution to all problems, however. And one of these is that, in my experience, it is difficult for private equity houses to relocate their teams to Luxembourg, even though this should be an important element of the strategy. Indeed, while it makes sense that investment teams would be present in target countries, and even though EU regulations specifically state that a fund established in one EU jurisdiction can be managed by a manager established in another, the fact remains that tax authorities expect management and back office functions to be located to a large extent in the jurisdiction where the investment vehicle is set up. As mentioned during Part 1, the introduction of the so-called Principal Purpose Test, or PPT, in tax treaties has increased the burden of proof for taxpayers who wish to claim treaty benefits, and having teams on the ground in the jurisdiction where your fund is established and where your intermediary holding companies are located can only be helpful in the context of such a principal purpose discussion. This slide outlines an investment structure that we still see in a number of instances, whereby a foreign fund investing in Europe sets up for each new transaction an ad hoc intermediary holding company in Luxembourg and a local acquisition vehicle to purchase the target company. By the way, this is also a structure that we see used by MNCs. This structure illustrates well the change in paradigm that the new PPT and other anti-abuse provisions have induced. For a long time, investors have focused on only two issues: making sure that the holding company was managed and controlled from the right jurisdiction, thus meeting most resident tests in tax treaties, and had sufficient substance locally to avoid being disregarded by the tax authorities of the investment countries. This structure, if implemented with enough discipline, could pass both these tests and has been used on many deals. But due to the change in landscape, this has now become the perfect illustration of what should not be done. It is now clear, and supported by case law in various jurisdictions, that economic substance is only marginally helpful when it comes to discussing the motivations that have led to the creation of this structure. On that front, courts focus on the actual effects of the company, as it helps improve the financial capacities of the investors, for instance by allowing them access to a financing that they would not have obtained at the same conditions in the absence of the holding company. Does this company bring to the table through its personnel a particular expertise, or the ability to better manage certain risk-off functions? These are the type of questions that investors now need to be prepared for. There is no perfect structure, of course, but this chart shows a situation in which the level of comfort on PPT and anti-abuse is dramatically increased compared to the structure shown on the previous slide. In this structure, the creation of a master holding company can be easily explained by the need to group various partnerships composing the fund platform into a single investment entity, which will act as top European entity and will channel investments in various EU jurisdictions. The creation of an additional intermediary holding companies can be justified, for instance, by the desire to have co-investors step into the shareholding chain at a level above the acquisition vehicle that draws the financing. In the example here, it is further strengthened by the fact that it serves as the parent company for the investment in Deal 1, a French and Spanish group. On top of this multi-investors and multi-assets approach for the intermediary holding companies, the onshoring of the fund, in Luxembourg in this example, would also provide additional justification for the use of Luxembourg as the jurisdiction of the intermediary entities. In summary, private equity funds or multinational groups who channel their investments into Europe through intermediary vehicles need to step up their game and learn to make the most of these intermediary entities. As before, they need to ensure sufficient substance, but the narrative behind that substance now needs to be stronger. Many players have started a long time ago to hire their own teams locally rather than use the services of local domiciliation and corporate services company. But in many instances, these local teams remain small and are given only limited authority, which opens the possibility for the tax authorities to argue that the relatively minor functions performed could have been located anywhere. Private equity houses need to consider relocating more senior teams, and MNCs should consider turning their holding companies into actual headquarters. In both cases, this implies either bringing in personnel from the jurisdictions in which they are based today, or take advantage of growth to locate new hires at the investment platform level. Certain tweaks can also be made to the standard practice by allowing the intermediary companies, in this structure on the slide before, that would be the master holding company, to recycle proceeds from deals, for example, to pay fees or even to make new investments. It is a difficult change, and the potential financial impact on the IRR means that these situations will likely remain exceptional, but having the flexibility and making use of it once in a while can only be helpful in beneficial ownership and business purposes discussions. Finally, some players have hoped to solve their issues by selling the intermediary holding company instead of having that company sell the underlying investment. The argument there is that, in the absence of taxable event locally, there should be no treaty eligibility issue, as no treaty protection is sought. Practice shows that buyers are not welcoming this idea with great enthusiasm, as they are in effect taking over the weaknesses potentially embedded in the seller structure. Also, if the intermediary entity's sole asset is the underlying shares and its substance and purpose is weak, other anti-abuse rules may kick in, whereby the target jurisdiction could try to argue that the sale of the intermediary company artificially disguises a taxable sale of the local target, and then the buyer may be caught in that storm. So the recommendation is to bite the bullet and accept that while investments from a foreign parent into an EU country can still be channeled via a third jurisdiction, the investor's presence in that third jurisdiction now needs to be a focus in itself, and can no longer be an afterthought left to corporate service providers and lawyers. And with this, Andy, I turn it over to you to talk about the Asian aspects.
Thanks, Benjamin. As Benjamin noted for the EU, the need for a country-by-country tax analysis is also true when it comes to Asia. And there is no region-wide tax principle such as the EU directive applicable to the European Union countries in Asia. To illustrate the differences among the countries, territories in Asia, let's look at this slide, which covers outbound dividend withholding tax rates from selected Asia-Pac countries. Starting from the Far East side, Australia and New Zealand have their own unique franked dividend system, which in effect ties the instance of dividend withholding tax to whether the underlying profits have been subject to corporate level tax. India has been interesting until the very recent shift to a regular dividend withholding tax regime effective April 1 this year. Prior to the change, India imposed a dividend distribution tax, or DDT, of roughly 20%. But what was significant was that the DDT was a tax on the local paying company, and the reduced rate under India's treaty was irrelevant. Now with the change and the domestic withholding tax rate of approximately 20%, the treaties will be relevant in determining the applicable dividend withholding tax rate. Hong Kong, Singapore, and Malaysia operate under a territorial or a hybrid territorial tax regime, and they impose nil withholding on outbound dividends. For the other countries listed here, you can see in the slide that the withholding tax rates range from 10% in the case of China to 30% in the case of Philippines. Certain treaties can significantly reduce these rates, so we do see active treaty-based planning on inbound investments into these countries to benefit from treaty-reduced dividend withholding tax rates. A point of note here is that Japan has a treaty with the U.S. that provides for zero withholding tax on qualifying dividends. In addition to the dividends we saw in the last slide, almost all Asian countries impose a withholding tax on outbound interest and royalties. Many countries also impose a significant tax on capital gains income at exit. This is why treaty-reliant structures, such as an intermediary holding company, are widely used for target acquisitions in Asia. As an alternative, there is the option of using an onshore special purpose vehicle structures, depending on the target country involved and on the specific asset being acquired. For example, if a real estate asset is involved, countries such as Korea, Japan, and Australia offer the option of using an onshore SPV structure such as the trust structures in Australia, the real estate fund, or the asset-backed securitization vehicle in Korea, and the well-known TMK structures in Japan. The advantage offered by these onshore structures is the reduced reliance on treaties and the ability to lock in domestic tax law preferences, such as zero withholding tax on qualifying outbound dividends. One significant disadvantage is the bells and whistles required to set up these structures, which can be impractical and cumbersome. Benjamin also talked about the substance requirements and the application of the Treaty Principal Purpose Test, or PPT, for the holding company to avail of the desired treaty benefit. This is also relevant in Asia whenever a treaty benefit claim is being made. In many Asian countries, the focus of tax authority scrutiny is on whether the treaty claimant holding company has adequate physical and economic substance. The problem being that there often isn't any useful guidance on what constitutes adequate substance. Based on experience, the important elements tend to be the number of employees at the holding company location, employees and office lease agreements, the specific roles the employees carry out, and the exercise of a typical shareholder rights and duties. Principal purpose tests will increasingly be used by the Asian country tax authorities to challenge treaty claims. Many Asian treaties already contain the PPT provisions in their treaties, and Asian countries have committed to fast-tracking the inclusion of the PPT in their treaty network through the OECD multilateral agreement process. There is no one-size-fits-all holding company location for Asia. Jurisdictions such as the Netherlands and Luxembourg and others listed on this slide have been used with some frequency depending on the target country, the tax benefit objective, and the existing substance at the holding company country. So what are the relevant considerations to ensure that an adequate substance and PPT elements are baked into the initial structure? If you already have or are planning to add to the existing operational substance in, for example, Singapore, it clearly makes sense to leverage this platform to acquire the target. But the exact structure set up can have implications on whether the overall substance that an MNC has in, for example, Singapore, can be utilized for purposes of the treaty benefit scrutiny by the target country tax authorities. A relevant analysis is whether the holding company only owns one asset, for example, shares in an Indonesian target company, or is a multiple asset owning platform. We have found in practice that a holding company structure that directly owns many Asian operating subsidiaries has had a significant greater success in defending its treaty claim with other Asian countries as compared to a single asset owning holding company. For private equity funds, onshore fund platforms may provide the ability to aggregate the substance at the manager level for purposes of the target country tax scrutiny on treaty claims. Peter will in a bit walk you through the exciting possibilities of structuring such onshore platforms in Singapore and Hong Kong. In case the target country tax authorities deny the holding company treaty claim based on inadequate substance, the issue of whether they will then look through will need to be fully assessed. Private equity funds are increasingly faced with this issue and whether they should adopt this look-through approach and fall back on each investor's treaties if applicable. This will be a dynamic area of development in the years to come and require upfront communication with the investors as well as collection of the relevant investor information and certifications. A couple practical recommendations in the initial structuring phase. We have seen tax authorities in Asia focusing on who the officers and directors of the entities in the acquisition structure are. They have looked at this seemingly harmless fact to argue that a holding company or the Cayman fund in a private equity fund structure is exercising important decision-making powers, or that the fund has a permanent establishment in the target country. Therefore, care should be exercised in assigning officers and directors to each of the structure entities, as well as target company, to ensure these risks are minimized. In this regard, it is highly recommended that deal-specific personnel are not assigned as officers and directors in these entities. On a related note, discussions should be held up front to ensure that proper monitoring and protocols are in place with regard to the target country activities of the deal team. Here are just a few additional points on substance, PPT, and permanent establishment risk management generally applicable in Asia. Regarding physical substance, we are seeing clients looking into and restructuring their entity structures to better align the fragmented substance in a particular country to the legal structure. We'll look at how this so-called halo substance may be achieved in the next slide. On economic substance and also for PPT purposes, as discussed earlier, establishing holding companies' deliberations and central involvement in key decisions relating to its shareholder status in the target company is critically important. For this purpose, it is recommended that some type of internal operational guidelines be drafted to ensure this takes place from the get-go. Such guidelines are often very useful in providing specific course of action that should be taken for each relevant transaction, and in making sure substantiating documents such as board meeting minutes and communications are retained in an orderly manner. In addition, contemporaneous documentation of non-tax business drivers for the holding company location will be useful as part of the overall tax defense position. On the PE issue, the following would be the key factual pressure points, and rectification steps should be taken well in advance of exit to reduce the risk of a PE-based tax challenge at exit by the target tax authorities. First, physical number of days spent by, for example, the Hong Kong-based deal team in the target country. Second, the type of activities engaged by such deal team in the target country, fundraising, seller identification, and negotiations, and others. And third, the activities carried out by a local management subsidiary in relation to the target company. Due to the lower PE threshold trigger adopted and being adopted by Asian countries in their treaties, PE-based challenges in Asia are here to stay and likely will get more intense. This structure on slide 16 should look familiar since Benjamin covered a similar structure in his EU discussion earlier. This master sub-holding structure is very much in play also in Asia, and I want to make several key points on the inner workings. In the structure here, we're using a Dutch two-tier structure with each sub-holding company or sub-HC directly holding shares in respective targets in Korea, Taiwan, and Indonesia. Under the Netherlands treaty with each of these countries, capital gains income at exit would be exempt from source country taxation. You also see a fully operating entity in the Netherlands on the left side of the structure. However, this OpCo is a separate legal entity from master holding company, MHC, resident in the Netherlands. The question here is whether the target countries will count this substance in OpCo for purposes of determining whether MHC can avail of the Dutch treaties with the target countries. The likely answer for all three target countries here is no. Then a couple things that the MNC or the private equity fund can consider here as possible pre-exit transactions. First is looking at dropping OpCo in a tax-free internal reorganization under MHC. A parent-subsidiary relationship has a better chance of getting substance attributed to MHC than the existing brother-sister relationship. The better option may be to change the entity form of OpCo from a corporate form to a flow-through form, such as a limited partnership, LLP, or a trust, in addition to the previously mentioned drop-down transaction. This will allow for a stronger argument for the aggregation of OpCo substance with MHC. Obviously, the feasibility of this will depend on availability of such flow-through entities in the holding company jurisdiction, whether it can be achieved tax-free, and whether such entities would be treated as flow-through under target country tax and legal rules. Any pre-exit planning or restructuring like the one discussed in the previous slide needs to be carried out as soon as possible and well in advance of the contemplated exit. Many tax authorities in Asia tend to scrutinize restructuring done close to the actual exit closing and have branded such actions as purely tax-driven with no business purpose. In addition to business rationale substantiation for such restructuring, making them old and cold for target country tax purposes will be important. We already talked about the importance of collecting in advance the investor-specific information in case the look-through approach is sought by the fund. Once again, this can be a cumbersome and time-consuming process, so getting this done well in advance of closing is highly recommended. Once a buyer or a set of potential buyers is identified, it is vital to engage with the other side on the tax implications and specifically the withholding tax mechanism. The buyer is usually on the hook for not withholding the tax from his purchase consideration paid to the seller. In practice, it is becoming increasingly difficult and time-consuming to convince the buyer on no capital gains tax position due to the subjective nature of the substance inquiry and the lack of clear guidance on what constitutes adequate substance in many Asian countries. Lastly, in anticipation of potential negative press coverage of the tax-efficient exit, a public relations and communication strategy should be considered and put in place before the exit. The risk of being on the front page of newspapers is not too remote a risk, and its impact on the ongoing business in that target country cannot be underestimated. We've reached the last stage. We've all heard about midnight tax raids at local target office and related horror stories of files and computers being taken away in some cases. So all hell breaks loose and you find yourself smack in the middle of a tax audit. In many countries in Asia, there may not be meaningful technical guidance available that addresses the complex cross-border tax matter in hand. This is where the OECD tax principles and foreign country tax guidance can be utilized strategically during the tax audit itself and in post-assessment appeals. For example, in looking at an earn-out type payment, there may not be any tax rules or judicial precedent on how that payment should be treated for local tax law purposes. Here, it would make sense to look at how, for example, such payment is treated in other OECD member countries. A critical element in successfully resolving a tax controversy in many parts of Asia is the ability to balance and straddle the technical tax arguments and the so-called art aspects, which are as important as putting together excellent tax defense briefs. Knowing the tax auditors and engaging with them in a culturally appropriate manner, as well as being cognizant of the importance of so-called saving face, are critical ingredients in the overall tax controversy strategy in Asia. Each country will have their unique tax appeals process, from an initial administrative appeal process to a full judicial appeal venues. Procedural rules governing the transition from one level to the next and whether to skip certain appeals venues will be part of many decisions that will need to be made. The customary practices in the country at issue also need to be assessed. For example, in India, tax matters are usually represented by well-known individual lawyers. China will be a whole different story, where in many cases, going to a standard judicial review may not be feasible. With that, let me now turn it over to Peter to talk about Singapore and Hong Kong onshore platforms. Peter, it's all yours.
Thanks, Andy. Singapore is becoming the jurisdiction of choice for investment fund structures, and it is starting to replace the Cayman Islands as the jurisdiction for Asia investment funds. This is largely because of a tax exemption, which applies if there is a qualifying fund managed or advised by an approved fund management company in Singapore, earning prescribed income from designated investments. A qualifying fund is either an LLC, a limited liability company, or known as a PTE Limited in Singapore, or a variable capital company, a VCC. Variable capital companies are a new phenomenon in Singapore. The law took effect in January of this year, but it's catching on. Most funds which are being set up at the moment in Singapore are actually VCCs, and existing LLCs are being converted into VCCs because of the low threshold requirements and the advantages that the VCCs offer. A flexibility in distributing income and the possibility to create legally segregated sub-funds. The fund must be tax resident in Singapore, and it must be approved by the Monetary Authority of Singapore, MAS, and incur an annual local expenditure which includes management fees, of at least 200,000 Singapore dollars. This is equivalent to about 145,000 US or 128,000 euros, and this is an annual expenditure requirement. If the fund has at least 50 million Singapore dollars of assets under management, which is equivalent to 36 million US or 32 million euros, it will in principle qualify as an enhanced tier fund. The benefit of that is that there are no limitations with respect to the investors in the fund. Otherwise, it could only be a so-called Singapore resident fund. And Singapore companies holding an equity stake of 30% or more in such a fund will be taxed on their proportional share of the income earned by the fund. The fund must be managed or advised by a MAS-approved fund management company in Singapore, employing at least 2 in the case of a Singapore resident fund, or 3 in the case of an enhanced tier fund, qualifying investment professionals. And the fund management company must be either registered with or licensed by MAS. Prescribed income must be earned by the fund, and the prescribed income would include all the usual income types that you would expect to see with investment funds, but notably it does not include Singapore real property income, and neither does it include interest from Singapore borrowers. That sort of income would be taxable income at 17%. The income must be earned on designated investments, and designated investment covers most investment assets, which includes, by the way, commodities, but it typically does not include Singapore real property assets or shares in real property companies. There's one exception, and those are units in a Singapore REIT, which is a Singapore-listed unit trust. Some miscellaneous remarks. Interestingly, Singapore's legislation allows existing overseas funds, for instance, Cayman Islands funds, to re-domicile and migrate to Singapore and become a Singapore Incorporated LLC or VCC. It's likely that they will choose a VCC form, but the possibility is there under the law to convert from the Cayman Islands into Singapore. The Singapore Tax Authority, the IRAS, has committed to issuing tax resident certificates to qualifying Singapore funds. This offers, in principle, access to Singapore's 88 double tax treaties. If the fund has borrowed money to make investments, any offshore interest cost incurred by a Singapore-based fund is exempt from withholding tax, and this saves the 15% withholding tax otherwise due. Singapore has a GST, which is Singapore's equivalent of the European VAT. The rate is 7%, and it will be charged by a Singapore fund management company on its management fees charged to the Singapore fund. The good news is that 88% of that GST will be refunded to the fund, so effectively reducing the GST on fund management fees to 0.84% only. And lastly, fund management companies may qualify for a lower income tax rate of only 10% instead of the standard 17% rate on the net profit from the management fees and the carried interest if they have at least 3 qualifying investment professionals managing qualifying funds with assets under management of at least 250 million Singapore dollars. That's equivalent to 180 million US dollars or 160 million euro. How does a typical Singapore fund structure look like? Broadly, what you see on this slide here is what you would probably in most cases see, which is a Singapore LP, or it could be an overseas LP, feeding into the master fund, which is the Singapore VCC company or an LLC company. And typically the VCC or LLC would be managed by a MAS-approved Singapore fund management company. The master fund company would be investing either directly into the designated investments, or it would do so through either a Singapore or an overseas SPV. This structure offers full flexibility and is showing to be a popular structure. Let's now move to Hong Kong and have a look at the Hong Kong investment funds. With effect from April 1, 2019, a qualifying Hong Kong resident fund managed by a qualifying Hong Kong resident fund management company, registered with or licensed by the Securities and Futures Commission, the regulator in Hong Kong, will be exempt from profits tax on qualifying transactions. A qualifying fund is either a Hong Kong open-ended fund company, referred to as an OFC, or it's a limited liability company in Hong Kong called a limited. It must be a collective investment scheme under the Securities and Futures Ordinance. Certain arrangements are specifically excluded from the exemption, such as group captive funds and employee funds. Hong Kong funds are subject to a slightly heavier touch of regulatory requirements compared with Singapore. Open-ended funds must be managed by an SFC licensed fund management company, and non-open-ended fund companies, the so-called LLCs, are subject to certain restrictions with respect to the number of independent investors and income of the fund which is paid to the fund's originators. Typically, qualifying transactions under the tax law are buy-sell transactions in a wide range of prescribed assets. And the range gets even wider if the fund is an open-ended company, a so-called OFC. However, and that's something to note, it does not include income from these investment assets. For instance, interest. And that disqualifies Hong Kong funds for credit fund purposes, because with this current tax rule, credit funds would be subject to income tax, profits tax as it's called in Hong Kong, on the interest that it would earn, and they will be taxed at 16.5%. There are certain limitations for investments in Hong Kong private companies and businesses by the fund, and there are also certain limitations on the investments that the fund can make through SPVs. Let me start with the first. Any investment into Hong Kong private companies and businesses should contain no or only up to maximum 10% of Hong Kong-based real property assets. And they are subject to a 2-year holding period unless the assets concerned predominantly consist themselves of long-term assets, which are assets held for at least 3 years. Any investments made by the fund through SPVs, whether Hong Kong SPVs or overseas SPVs, should not be in publicly listed securities because they will not qualify for the exemption. And the SPV itself must confine its activity to holding and administering its investments. It cannot do anything more because that would disqualify the income from being tax exempt. Neither is the SPV allowed to invest in LPs or trusts, regardless of whether these are listed or private entities. So you see that there are a few limitations here that people should pay notice of. An anti-avoidance provision will apply to Hong Kong-based investors in the fund who own at least 30% of the equity of the fund, because they will be deemed to have earned the trading income of the fund and they will be taxed at 16.5% profits tax on that deemed income. So the fund structure would typically assume that smaller scale Hong Kong-based investors come in and not investors with stakes of at least 30 or more %. Some attention points. There is no inbound redomiciliation facility in the law for overseas funds who are looking to migrate to Hong Kong. So unlike Singapore, overseas funds cannot redomicile into Hong Kong. Unlike Singapore, Hong Kong doesn't have a minimum business expenditure test. Neither does Hong Kong have a GST or VAT. on fund management fees. So in those two respects, Hong Kong is definitely a better location. But on the other side, there is no tax incentive for fund management companies in Hong Kong. They will be taxed at the standard profits tax rate on their net profits at the rate of 16.5%. Hong Kong has about 40 double tax treaties at this moment, and the Hong Kong fund regime offers access to those 40 double tax treaties. How does a typical Hong Kong fund structure look like? In many respects, on the same principle and concept as a Singapore fund structure, you would look at a Hong Kong OFC or LLC fund company managed by the Hong Kong Fund Management Company, and either a Hong Kong limited partner feeder or a foreign feeder or direct investors could come into the OFC or LLC company, and the fund itself would either make direct investments, and those would be direct investments in either public or private stock, or it could do it through a Hong Kong or overseas SPV. But the thing to note, if they invest through SPVs, is that it can only be investments in private company shares or private company loans or bonds. It cannot be public securities.
Now we'll go south to Brazil. Celso, welcome.
Thank you very much, Andy. As discussed on the previous presentation, Brazil fund structures for inbound investments are quite regulated by the CVM, the Brazilian version of the SEC, and the Brazilian Central Bank. Given that, I recall you that such fund structures are exempt from corporate taxation as well as VAT taxation locally. Moreover, foreign investors into a FIP infrastructure and or PII may be able to receive dividend distributions or the proceeds related to the interest redemptions or sales of its interest without any withholding taxation in Brazil. Of course, as discussed on part 1 of this webinar, that will only be possible if some requirements are met. I refer you to slide 37 for a graphical quick overview of some requirements, tax benefits, and risks associated to such structures. On the other hand, we have seen in the last few years the abuse of form and the lack of substance in the usage of the Brazilian fund instruments. Since the Brazilian tax law do not have a specific set of anti-avoidance rules for funds, tax authorities have been successfully using the general anti-avoidance rule set up on the Brazilian legislation to disregard some structures and tax them as a normal corporate business entity, meaning taxing income and revenues of such funds. Such Brazilian IRS strategy on challenging some funds have brought up relevant case law in the Brazilian administrative and judicial courts. The so-called paper funds, without any economic substance whatsoever, despite the goal of tax evasion, have been disregarded from time to time. So what we usually recommend for those interested in setting up a Brazilian inbound fund structure is to perform an economic substance test, answering, first, is the fund to be used as a platform for a long-term inbound investment into Brazil, or is it a one-shot deal structure? Does the fund have a professional and specialized asset manager locally and or abroad, or does it use a third-party professional service provider? And third, how many different investments does the fund and its manager overlook and invest in Brazil? How many different unit holders does it have? Being watchful on such questions and structuring it appropriately Brazilian inbound funds can be very successful in minimizing local tax impacts. On this slide, I refer you to a chart on the withholding taxation of each vehicle and its basic tax rules requirements to take advantage of the benefits as well as the risks associated with the structure. With those requirements, I pass you to Jason Osborne.
Thank you, Celso. For the remainder of the session, I'm going to talk about remedies, particularly the Mutual Agreement Procedure, or MAP, under tax treaties that fund investors in multinational companies can pursue in their residence jurisdictions to resolve disputes and obtain relief resulting from double taxation arising from source country tax disputes. Specifically, I'll focus on MAP remedies available under U.S. tax treaties to U.S. fund investors and MNCs, but similar MAP relief may be available through bilateral tax treaties to investors and multilaterals in other jurisdictions. So what is MAP? MAP is both an article of tax treaties and a process that allows the competent authorities, meaning a special designated office within the tax administration, to negotiate and implement mutual agreements that eliminate taxation inconsistent with the terms of the applicable income tax treaty. MAP is most typically invoked in transfer pricing cases, but it can also be used to resolve a wide range of other international tax disputes within the scope of tax treaties, including permanent establishment issues, issues of residence, source and withholding, qualification for benefits under limitation on benefits articles, and in some cases, the application of domestic anti-abuse provisions that give rise to double taxation. So almost all income tax treaties have a MAP article. They are generally consistent in most respects, but they do differ in some key details. Strictly as an illustration, this slide presents the first two paragraphs of the MAP article of a U.S. model tax treaty. Some elements that I want to note here is first, like most treaties, the MAP article on the screen allows taxpayers to present issues that give rise to taxation inconsistent with the treaty to the competent authority without regard to domestic remedies. In other words, to pursue MAP, there's no obligation to exhaust domestic remedies first. Second, MAP articles impose on the competent authority an affirmative obligation to at least endeavor to negotiate a mutual agreement if the taxpayer's request for relief is justified and the competent authority isn't able to resolve the case unilaterally. And third this model article, as well as most actual MAP articles, they provide that MAP resolutions can override domestic law, including statutes of limitations. So in addition to tax treaties, taxpayers also need to be mindful of the procedural rules for MAP in each jurisdiction. In the United States, for instance, Revenue Procedure 2015-40 prescribes detailed procedural rules for U.S. taxpayers to file MAP requests. So how exactly does MAP work? Well, MAP begins with a taxpayer request to the U.S. and or the applicable treaty partner competent authority. Upon receiving the request, competent authority will first determine whether it can grant relief from double taxation unilaterally. This can happen if the foreign taxing authority's action appears reasonable on its face and the competent authority believes it should be accepted without further discussion. However, as is more typically the case, the competent authority will typically decline to grant relief unilaterally, then will seek a resolution through a negotiated bilateral mutual agreement with the other competent authority. These bilateral negotiations are government-to-government negotiations, but the taxpayer may provide important input and help facilitate resolution behind the scenes. ultimately, disputes in MAP are resolved through bilateral negotiations one of three ways. First is by withdrawal. The tax authority asserting the assessment can agree to withdraw the assessment at a negotiating table. The second way is through correlative relief. In a case of correlative relief, the taxing authority's assessment stands, but the other tax authority agrees to grant relief from double taxation by allowing either a deduction or a credit so as to relieve the double taxation that results from the assessment. And third, and this is typical in transfer pricing case, you'll have some sort of a negotiated result involving a combination of partial withdrawal and partial correlative relief. In general, the MAP process is very effective, but it's important to point out that there's generally no guarantee that a resolution will be reached. The language of treaties generally requires that the competent authorities only endeavor to conclude a mutual agreement that eliminates double taxation. Under BEPS Action 14, there is an aspirational commitment by most of the world's tax administrations, including the United States, to resolve MAP cases within a 2-year period, but there's generally no time limit on a case-specific basis. As an exception, an increasing number of treaties, including the United States treaties with the 7 jurisdictions listed on the slide, contain a mandatory arbitration provision, which provides for binding resolution by a panel of arbitrators if the competent authorities are not able to resolve a MAP within 2 years of receiving a MAP request. The table on this slide presents statistics published by the OECD on the outcome of MAP cases that United States Competent Authority closed in 2018. The bottom line results illustrate that most MAPs are resolved on favorable terms. Of 251 cases resolved in 2018, 192 were resolved by mutual agreement that eliminated all double taxation, while another 17 were resolved unilaterally. So overall, it's over 80% of MAP cases were resolved on terms favorable to taxpayers that eliminated double taxation. While MAP can be used by U.S. taxpayers to resolve either U.S. or non-U.S. initiated tax disputes, this slide discusses some of the special considerations for U.S. taxpayers seeking relief from foreign-initiated actions. One key consideration is the timing of the request. Under Revenue Procedure 2015-40, U.S. taxpayers have the flexibility to file a MAP request as soon as there's a double tax issue that is likely to arise. Theoretically, this can happen very early in a foreign tax audit. But in my experience, most MAP requests are held in abeyance by the competent authority as not yet being ripe until the foreign tax authority has issued a foreign assessment. So just because as a U.S. taxpayer you can invoke MAP very early in the process, does this necessarily mean that U.S. taxpayers should? And the answer here is it really depends. In some cases with some tax administrations and for some issues, it may be advisable to seek administrative or even judicial review first. But on the other hand, in other jurisdictions, foreign law can limit the ability to seek a MAP resolution if a taxpayer enters into a settlement with a foreign taxing authority. So here, the bottom line is the best practice is to always seek advice on the timing of a MAP request from a qualified advisor in each relevant jurisdiction. There are several other relevant considerations for U.S. taxpayers seeking MAP relief from foreign-initiated action. One consideration is the role of non-treaty country intermediary entities in the structure or in a transaction. This is a common issue we see with fund structures. The presence of non-treaty country intermediaries, it needs to be considered on a case-by-case basis, and it may or may not impede access to MAP. Another consideration is whether to seek a pre-filing conference with a U.S. And or the foreign competent authority before filing a request. Again, this needs to be considered on a case-by-case basis, but it's typically advisable for large and complex cases, and it's often advisable to have a pre-filing conference before entering into a material settlement with a foreign taxing authority. And then lastly, it's important to note that in many cases, the MAP process is the only way for a U.S. Taxpayer facing a foreign tax assessment to seek relief from double taxation in the United States. So-called self-help of just amending your U.S. return to claim additional deductions to reflect an audit settlement generally is not allowed. In some cases, U.S. taxpayers can amend their returns to increase foreign tax credits for increased foreign taxes paid as a result of a settlement, but as I'll discuss later, U.S. taxpayers generally must invoke and exhaust MAP first before claiming foreign tax credits. It's important for U.S. investors and multinationals concerned about the impact of foreign tax assessments to preserve their right to MAP relief. U.S. taxpayers should be aware that while MAP articles generally override domestic statutes of limitations, the treaties themselves may provide their own time limitations on when a MAP request can be filed. These time limitations can vary greatly, so it's important to check each treaty. Of the treaties that provide a time frame for filing a case, most are based off of the issuance of the assessment. In other words, like 3 to 5 years from when the assessment is issued. However, others, like the U.S. treaties with Canada and Mexico, base the deadline off of the end of the tax year or the return filing date. These treaties force taxpayers to be more proactive in anticipating disputes. If a U.S. taxpayer isn't able to file a MAP request within the treaty time limit, it can still preserve its right to file a MAP request later by filing a treaty notification. It's a simple one-page filing with a U.S. or the foreign competent authorities. An additional protective measure that U.S. taxpayers should consider taking is to file protective refund claims in the United States in order to toll the U.S. statute of limitations on refunds. If a MAP resolution is ultimately reached, a protective refund claim is not strictly necessary because MAP articles do override the statute of limitations. However, protective claims are important to preserve other non-treaty-based rights to relief, including refund litigation in the event that a MAP proceeding is not successful. So if MAP relief is not available or it's not effective, one other recourse U.S. taxpayers may have to obtain relief from double taxation arising from a foreign tax assessment is to claim a foreign tax credit in the United States. There's two relevant credits, the Section 901 direct credit, which applies if a U.S. taxpayer pays foreign tax directly, but there's also a Section 902 indirect tax credit, which can apply on foreign tax deemed paid on dividends received from CFCs. It's been repealed effective as of 2018, but nevertheless, it may still be available in the case of pre-2018 foreign tax audits. This slide sets forth 5 questions to consider in deciding whether an increase in foreign tax arising from the conclusion of a foreign tax dispute is creditable in the U.S., each of which generally must be answered yes. I'm going to focus a little bit on the last 2 questions regarding exhaustion of remedies. There's a twofold exhaustion of remedies requirement that first requires taxpayers to exhaust the competent authority remedy, meaning MAP, when it's available. And second, there's also a requirement to exhaust administrative and sometimes even judicial remedies that might be available in the relevant jurisdiction. Exhaustion of remedies does not mean you need to exhaust all remedies, only those that are effective and practical. This means whether you can settle and still obtain foreign tax credits in the U.S. depends on whether a further challenge in the foreign jurisdiction would be reasonable in the circumstances, taking into account cost-benefit considerations. To substantiate exhaustion of remedies from a U.S. perspective, documentation of positions and reliance on opinions of foreign tax advisors as to the reasonableness of a settlement is absolutely critical. So this concludes my discussion of MAP and foreign tax credit remedies. So with this, I'll turn it back over to Andy to wrap it up.
Thank you, Jason. This concludes today's webinar. We hope the information shared today was useful. Please feel free to reach out to any of today's speakers if you'd like to discuss any of the topics covered today. Thank you so much for your participation, and have a great day.